In this video, we are going to talk about dividends and other forms of payouts that corporations do. So there are different types of payouts. Money a corporation gives to their shareholders. Many companies pay a regular cash dividend. This is the most common one, or at least the one that most people are aware of. And all it is that a public company, let's say quarterly, will send some cash out in the form of a cash dividend to their shareholders. Sometimes they might pay an extra cash dividend. They call those special dividends, and a combination of both. And the extreme case will be a liquidated dividend, and just what it sounds like when they're liquidating the company. Companies will often declare stock dividends. Now, let me first introduce a term, stock distribution, which is the general term that covers stock dividends and stock splits. You may be familiar with the term stock splits because it's the most common term used out there for this type of activity, but the formal terminology is stock distributions, and it comes in two flavors: stock dividends and stock splits. Stock dividends and stock splits are very similar. They have a few exceptions and differences. One of the key ones being the way in which they accounted for in the balance sheet, which may impact the value of the firm in different ways, but that's for a more advanced situation. Just understand that there's cash dividend, stock dividend, and stock split. A stock dividend and stock split are very similar, with some difference in the way they're accounted for. And then you have stock buybacks, where the company repurchases stocks, so the shares outstanding will become lower. Typically, if the firm has the same value or higher, that means that each share will increase in price. The standard methods of a cash dividend: payment cash by the firm to shareholders. They just declare it, it gets executed, and they get it. You may hear this terminology, the ex-dividend date and the record date. The ex-dividend date that determines whether stockholder is entitled to a dividend payment. Anyone holding stock immediately before this date is entitled to a dividend. So this is what happens. It's an order of events. There's going to be a declaration date. That's when they make it official and declare we are going to pay a dividend in this much. But what happens is that declaration date is not the day they pay the dividend. That dividend may be paid 3 months from them, from the declaration date. So what happens is people are buying and selling these shares during that time. So the question comes, who has the right to that dividend? Because if you sell the share one day before the dividend, then yes, the previous owner gets the dividend, not the next owner. So the ex-dividend date pretty much sets a deadline. If you own the share on them before this date, you get the dividend. If you own the share after that date, you do not. The previous owner gets it. And then you have record date on which the company determines existing shareholders. Pretty much the day of record, and just what it sounds like. It's just a list of names. Procedure for cash dividend. There we go, as I mentioned, but now you can see it in a chart. You got a declaration date. Then you got the ex-dividend dates. Everybody that was the owner of the shares on this date or before gets the dividend. If you own it after, you do not get that dividend. Then you got the record date, which, as you may see, the record date may have people listed that bought the shares after the ex-dividend date. So being on the record date list does not mean that you are entitled to the dividend. And then the payment date or the execution date. Homemade dividends. This is an example of a homemade dividend, but to do a quick explanation is, let's say a company does not pay dividends. That's fine. That's not a problem. There's a stock that instead of paying dividends, what happens is going to grow faster in price. That's the trade-off. Companies that pay dividends, the stock will grow at a certain rate, which is a little lower than the total. A company that does not pay dividends, it means that their stock price actually going to go up a little faster, is going to grow at a higher rate. And there's other reasons for that, but at the end of the day, is that the total return is going to match the required return eventually. So whether you get it through dividends or capital gains, your total return will be the same. So what you do is, for homemade dividend, if you have a stock that does not pay dividends, which means the price goes up a little faster, if you ever want to cash out some of your gains, you just sell a few shares and you get the cash that you want. This has a benefit is that you control to cash out when you want to. And well, things change from year to year. The general case is that you'll get a better tax treatment if you do it this way, instead of getting dividends, the cash dividends from a company. Dividends and investment policy. Firms should never forego positive NPV projects to increase a dividend or to pay a dividend for the first time. Okay, now notice here it's talking about increase and pay a dividend the first time. So let's first talk about that. So let's say the company has cash on hand and there are NPV positive projects available for the company to invest in. That should be the priority, to use that cash. And the priority should not be to increase dividend or to start paying dividends. Now, the reason it says increase or start is because if you already have an ongoing dividend at a certain amount, it is important for companies to continue paying that ongoing dividend for that amount, because it's okay if they don't increase it, and it's okay if they don't even start. But once you start at a certain amount, if a company all of a sudden decides we're not going to pay that dividend, or we're going to reduce it, it looks really, really bad, and the market will penalize the company by start selling the shares, and the stock price goes down. Repurchase of stock. Instead of declaring cash dividends, firms can rid themselves of excess cash through buying shares of their own stock. As mentioned earlier, they can just buy back the stock, but because the value of the firm doesn't change, the fact that there are less shares outstanding, that means that the price of the stocks that are left out there will go up to match the market capitalization. Now, in this scenario, the company said, is we're going to use the cash to purchase back stocks instead of paying out dividends or special dividend or increased dividends, etc. But that's okay, because since the stock of the price goes up, and if you wanted the cash, then you can practice the homemade dividend that we spoke about earlier and still get cash and potential tax advantage. And buying back stocks, it's a lot easier compared to the other processes. Easier in the sense that it's easier on the tax situation for the investors, and also as opposed to like stock splits and other things that way. So there's lower transaction cost. So share repurchase, flexibility for shareholders. As I mentioned, the homemade dividend is the flexibility. Keep stock price higher. Already spoke about that. If you have stock options, like they say, it is also very good for them. As an investment of the firm, if there's undervaluation, that is, and as I mentioned, the tax benefits. So let's touch a little bit on personal taxes, dividends, and stock repurchases so we can establish those differences. To get the result that dividend policy is irrelevant, we needed 3 assumptions. No taxes, no transactional costs, no certainty. Let me repeat that. Earlier, I mentioned that your required return on a firm would be the same whether it's a combination of capital gains and dividends or just capital gains without dividends. They just add up together that way. However, that value is the same when there's no taxes involved. But because cash dividends get taxed differently than capital gains, now we have a difference on the end result after everything is said and done when you pay cash dividends versus, let's say, stock repurchases. As you see here in the United States, both cash dividends and capital gains are taxed at a maximum rate of 15%. However, they're not the same. Cash dividends, as of right now, currently, get taxed as regular income. Well, they always get taxed. Let me put it that way. The rate does change and varies, but let's use the 15%, for example. But the dividend will always get taxed. Capital gains, however, not only get deferred because you really don't get taxed until you cash out the capital gains, but as of right now, currently, you can have long-term capital gains. That means that you held the stock for a year longer and get zero tax into a certain amount. So there is a significant tax advantage on the long-term capital gains versus just receiving dividends. And that's why it says here that the tax rate on dividends is greater than the effective rate on capital gains. There's more to it, but there's an advantage on it. Now, short-term capital gains, that will be taxed as regular income. Firms with sufficient cash. The above argument does not necessarily apply to firms with excess cash. Consider a firm that has $1 million in cash after selecting available positive NPVs. So they still have cash and nowhere to put it. So they can select additional capital budgeting projects. By assumption, these are negative NPVs. You don't want to do that. Acquire other companies. That's another possibility to use that money with. Purchase financial assets, repurchase shares. There would be other options like lowering debt and again, cash dividends. But the point is that, believe it or not, having a lot of cash sitting around for a company can be problematic on deciding which route gives the most value. Taxes on dividends. In the instance of personal taxes, a firm shall not issue stock to pay a dividend. So, as I mentioned earlier, if the companies are repaying dividends and they stop or reduce it, that's problematic. You need to find that cash one way or another before you do that, but you should not do it by issuing more stock. Also, even if it's a special dividend or an increase in dividends or to start dividends, no, you should not do it by issuing stock. It's done frequently by issuing debt, bonds, but that's capital restructuring. That's a different approach. Managers have an incentive to seek alternative uses for funds to reduce dividends because of the taxes that the investors to pay on dividends. It becomes a much lower value option. So it's better to always look at alternatives. Though personal taxes mitigate against the payment of dividends, these taxes are not sufficient to lead firms to eliminate all dividends. So yes, it's detrimental to have this tax situation going on, but for many, many reasons, whether it's behavioral or just valuation situations, there's still usefulness to have dividends for a company to pay dividends. Stock splits, just to elaborate a little more on that, essentially the same as stock dividend, except it is expressed as a ratio. And it says they're essentially the same as a stock dividend. I mentioned that earlier. There are some differences in the way it is accounted in the books. But for the investor, for most investors, it's less of an issue, the differences. But it may have an impact on how the market reacts to a stock dividend versus the stock split, but that's for a different class. For example, on the ratio, people may say 2-for-1 stock split. That means that for every one share, there'll be another one. So it doubles. But when they say stock dividend, they typically express it a percentage, and they'll say 100% stock dividend, meaning that it doubles. That's just all that means. Now, those ratios may be different. Stock price is reduced when the stock splits. So the initial mathematical technical side of things, if the company has not changed value and it was $10 million, the value of the company, and there were 1,000 shares out there, let's make it a little simpler, 1 million shares out there. So $10 million in value, the firm, 1 million shares outstanding. That means each share is $10. When you do a stock split or stock dividend, if the company is still worth $10 million, but now you have 2 million shares outstanding because you doubled it, you did a 2-for-1 or 100% stock dividend. You still got the $10 million, but now it's divided by 2 million. So the stock price is going to go down to $5. But now you have twice as many shares. And that's the reasons to do that. It's a different class, but that's what happens. However, the research shows that when a stock split or stock dividend happens, it sends a signal to the market, and there might be a jump in the valuation of the company for whatever reasons. So you typically end up with a little more. It doesn't always happen, but without that expectation or signal or other message or information that goes out there, if you do it strictly by the numbers, you still end up with the same value per share. I'm sorry, the same value overall, just a different price per share. Lower price, but more shares. That's it for this video. We will see you on the next one.